I want to begin the bulletin with the latest inflation numbers from the Ghana Statistical Service. Inflation for the month of February declined to 52.8% from 53.6% in the month of January. The Ghana Statistical Service is attributing this to a drop in the cost of transportation as well as non-food items. Let's take a listen to government statistician Professor Samuel Kabnenim address the media.
Consumer Price Index for the month of February 2023 stood at 168.7 for the month of February 2023. This compares with the Consumer Price Index of 110.4 for the month of February 2022. Given these two price indices for the month of February 2023 and February 2022, inflation for the month of February 2023 stood at 52.8%. This indicates that prices of goods and services on the average between February 2022 and February 2023 have gone up by 52.8%. That is, prices of goods and services over a one-year period, specifically February 2022 and February 2023, went up by 52.8%. We have sustained the reversal that we started in last month with the upward increase in inflation. It will be recalled that in January 2023, we had a reversal of the upward trend from 54.1% in the month of December 2022 to 53.6% for the month of January 2023. So we have sustained the reversal in the upward trend in inflation rate that we recorded greater part of 2021 and 2022. The difference on a year-on-year basis between January 2023 and February 2023 indicates that prices of goods and services went down by 0.8 percentage points between January 2023 and February 2023. On a month-on-month basis, contrary to the sustained reversal, we saw Consumer Price Index on a month-on-month basis inching up by 0.2 percentage point, as the 1.7% that was recorded in January 2023 went up by 0.2 percentage point for the month of February 2023, increasing to 1.9% for the month of February 2023.
Well, joining us to make sense of the latest figures, Courage Boti, who is an economist and research lead at GCB Capital. Thanks for your time, Courage. So where are we at in our quest to bring down inflation based on the latest figure we have now for the month of February?
Well, good afternoon to your listeners and yourself. Yes, I think it's impressive. We've seen another marginal decline in inflation for the month of February. It is significant because of the period where we've seen revenue interventions kicking. Specifically, government increased VAT by some 2.5%. That took effect. The complete reversal of benchmark policy, that means that imported goods no more have the benchmark discount values, also took effect. From February 1 also, I think the increment in water and utility tariffs also took effect, which means there was quite some price pressures around that period that could affect inflation. You saw that reflect in the headline month-on-month inflation and then headline non-food inflation for the period, with the headline month-on-month increasing by some 20 basis points to 1.9%, while the non-food figure also increased by some 80 basis points for the period. But for overall inflation, it was an 80 basis point decline for that period, which goes to tell us that the price pressures that we saw from the beginning of, I think, sometime May 2021 all the way till now are beginning to soften a bit. Particularly, the main triggers, I believe, have been exchange rate depreciation and fuel prices at the pumps. For this period, we've seen that some interventions on the local market, and then, of course, the easing of crude oil prices on the general market, global market in general, meant that we are not having as much pressure from export prices. And in particular, CD, even though not exactly stable, have behaved within a certain range so far this year, which meant that the depreciation problem is not so much pronounced. And we are seeing all of it in part reflect on relatively stable transport fares, stable fuel prices at the pumps, and relatively stable prices on the market compared to what we've seen in previous months and weeks, really. And I think these are the things setting inflation on that downward trend. I wouldn't say we have reached a peak yet, because some of these revenue interventions could have lagged impact. Maybe that could run over the next 2-3 months, especially for the February data window, which did not reflect all of these interventions really. I would be cautious to say we've reached a peak. You want to observe the trend over the next 2 and 3 months to see the clear trend that is emerging. Then we can conclude on whether 54.1 was the peak point of this wild inflation run.
Yeah, because I was wondering about the rate of decline. Yes, inflation is going down, but could it be faster? Is it going down as fast as we would have anticipated?
So, well, you could safely argue from the arguments I've advanced so far that inflation decline could have been faster than we've seen, the 80 basis point we've seen in February, but for some of these revenue measures, really. And until we incorporate their full impact and lag impact, really, you might not see very sharp declines in inflation. I understand there is a base pull effect, and it will get stronger as we go on. But we have to see the effect of these revenue measures actually fully reflect, and then you can begin to see the full impact of some of those base drift. And going forward, hinging on the IMF, if the cedi gains more stability and then oil market behaves the way it ought to behave going forward, with all of the interventions coming from within and without, really, then we could begin to see sharper inflation going forward. But the trend seems to be positive now, and it can only get stronger as the effect of the revenue measures that we've seen reflect in February decay.
And so from the perspective of government intervention, are they on track in bringing down inflation?
Well, I think the major thing government has done so far to try to affect fuel prices directly has been the goal for oil policy. It's a temporal measure, and I think the plan, so as I've heard it from the authorities, is that they intend to meet half of our national oil import, which I understand is valued around some $4 billion annually. They want to meet half of that. Now, if we can achieve that, then you could begin to see its impact on prices on the market, because the depreciation effect will not be transmitted fully, and you are having a government-to-government arrangement, which potentially could mean that you are not especially exposed to the fluctuations in the oil market as much as you would have it. And the interventions from the Bank of Ghana, at least from the BDC's forward auction, would also mean that we are bridging the FS gap a bit, which could reflect in reasonable prices or reasonable increases at the pumps relative to the sharp ones we've seen. And so to that extent, yes, I think there is some intervention in there. But most importantly, around this time, I think one of the triggers of inflation for 2022, beyond every other thing, has been the monetization of the deficit. We've seen about 43 or so billion central bank deficit financing last year. In this particular year, with the IMF on the horizon and all of that, you do not expect a lot of monetization of deficit this year, if any at all. Plus, at the moment, the domestic banking sector is awash with liquidity. And if those liquidities are not channeled to the appropriate sources or are not mopped up adequately, it has the potential of triggering inflation also. So I look forward to the March inflation monetary policy meeting and what decisions will come out. The expectation will be that there could be some marginal hike again, maybe 100 basis points, just to channel some of those liquidity in the banking sector into reserves and into the central bank, so that we limit its impact on inflation, especially now that banks have mostly adopted a cautious stance to loan book growth, really, given everything happening in the sector. So if we coordinate and synchronize those fiscal and monetary policy interventions properly, we should begin to see a much sharper decline in inflation going forward.
I want to switch topic and quickly ask you about the decline in T-bill rates. We've been discussing this in the last couple of days, and depending on which analyst you speak to, they say it's good or bad. Government's move to force down interest rates on treasury bills. Where do you stand on this?
Well, I don't think it's a question of good or bad. I think it's a question of what is prudent. Let me give you an instance. If you did domestic debt restructuring with the aim of saving interest costs because your fiscals are rigid and you do not have a lot of space, and interest cost alone was going to consume about 52 billion out of your total revenue you expect in 2023, and you have successfully slashed bond coupons from the average 19.5, 20% levels now to between 8.35% and 10% going forward. It is only natural that you bring down T-bill rate, and the 35% levels that were being given is not sustainable. It won't even help government realize the interest savings from the domestic debt exchange. So it was only natural. I think it was problematic when they were accepting everything tendered on the T-bill market and the rates they were being tendered. That sustained the rates where they were. Now, the government, I believe, have shifted to the strategy where they will guide the market down gradually, and they will do so by rejecting bids they consider far outside the range. It is working because at this moment, there is so much liquidity in the banking sector, and there are limited options for fund managers and investors in general beside T-bills at the moment. And so you have the leverage or the room to achieve that and force it down quite sharply. You need that to realign the market. This moment in time, most of the fund managers are unable to sell bonds to fund withdrawals from their clients. And the reason is the secondary market is non-existent. For as long as T-bills are offering 35, 34 and things in that area, you won't see activity on the bond market. So it's actually imperative for us to realign the market, bring back activity to the secondary market for bonds, and then you can effectively stabilize the market and ensure that the money market is working, bonds market is working, and then every other thing related is working so that the market can rebalance appropriately to restore normalcy from the shocks we've seen last year.
But there are some analysts who suggest that the decline is not backed by the current economic trends. The explanation is that, well, for the interest rates to drop, then we should see a significant drop in inflation. Otherwise, we're creating a problem for ourselves. And the fear that investors may turn to the US dollar, and then that will consequently strengthen the dollar. You know the implications on the cedi. Your thoughts?
Well, that argument is sound. I won't begrudge it, except to say that we are not in normal times, right? Inflation is 54% and now 52.8%. But it was there because of the abnormality in the system, right? And in any case, at 34, 35%, we were not having positive real returns anyway, right? Because inflation was still much higher. You compare ourselves to countries like Nigeria, Kenya, Egypt, and places like that, and they are running negative returns. T-bill rates are way below where inflation is. I think that is acknowledging the abnormality of the times we are in. And if we want to maintain positive real returns on these investments, really, then there was no point in even doing debt restructuring in the first place, right? And so I think we need to accept the abnormal times we are in, and that it will require drastic measures to try to keep the economy afloat. Then the rest can follow. On the exchange rate argument, yes, there is a possibility of that, and it is already happening. But that is where regulation needs to be strengthened and disclosures need to be strengthened so that we avoid such speculative tendencies, really. The Bank of Ghana has to do its job at this point. What we need at this moment is realigning the market, and the normal course of action can follow from there.
Courage, have you heard anything on the coupon payments for bondholders who opted out of the domestic debt exchange program? Our latest report was that the Bank of Ghana was in the process of finalizing payments to commercial banks. Any news from where you are?
Yes. I got news from friends and colleagues who are exposed to those there today that some have received coupon payment. Not that it will be paid, some have actually received coupon payment, really. So I think it's gradually coming to close now that those monies will be paid. Some people have actually received money already this morning.
All right, that's some good news to wrap up our conversation. Thank you so much, Courage Boti. Always fun to speak with you. Research lead at GCB Capital. I appreciate your time with us. Thank you so much. Well, next, Vice President Dr. Bawumia is projecting fuel prices to drop at the pumps beginning tomorrow. He's basing this on the gold for oil policy, which he says has already started making impact. The Vice President was speaking at the opening of a new head office for Bost in Accra.
I've been told that next week we are likely to see fuel prices fall again as a result of this policy. Next week is not actually Professor has just said it's not that far, it's tomorrow. Tomorrow we will see the decline in prices that we are expecting. I mean, this is remarkable. 2.5 months ago, you were at 23 cedis per liter. Today, you are at 12 cedis and falling. That is a good point. But let me point out that the most important aspect of the gold for oil policy is not just the reduction in fuel price, but the most important aspect is the savings in foreign exchange that the Bank of Ghana will make as a result of the lower demand for forex to import oil. That saving is huge. We are currently importing about 50 to 60% of our oil imports under this policy. The goal is to move to 100%, and that will be done this year. We will see this done with, and we'll work with the BDCs to make this happen. But the savings in foreign exchange, when we do this, will be an annual saving of around $4.8 billion US dollars every year when we get this done. And that means that the oil
and so expect fuel prices to drop beginning tomorrow, Thursday, at the pumps, according to the vice president there. Now, GB Foods manufacturing company has invested $5 million US dollars into a state-of-the-art tomato cannery. President Kwawu was at the commissioning, and here's more in this report.
GB Foods, leading food manufacturing company and producers of Ghana's favorite Gino and Pomo range of products, expanded their production line by commissioning a state-of-the-art tomato canning line in Tema. According to Karula Arthur, the state-of-the-art tomato canning is aimed at reducing the amount of raw materials imported in the manufacture of the company's products, thereby offering more employment opportunities to Ghanaians.
I am pleased to share our commitment to invest another $2 million in a solar plant to power this factory. Finally, we can play also a relevant role in Ghana's food security. We are working very hard to reduce food imports. In fact, this canning line is a key step in reducing the number of ingredients that we need from abroad. And our ambition is to achieve a fully Ghanaian supply chain of tomatoes.
Managing Director of GB Foods Ghana, David Aflu, said the company is committed to investing in Ghana.
Your Excellency, GB Foods believes in Ghana and remains committed to drive investment and grow our footprint in the country today and into the future. And today is a testament to that.
Special guest of honor, His Excellency President Nana Akufo-Addo, was optimistic of the success of the new GB Food tomato canning line and pledged government support.
We're determined to provide stability to our economy, to serve as the foundation for its sustainable and rapid growth. The goal of my government remains constant. We aim to unlock the full potential of the private sector and the Ghanaian sense of enterprise to create jobs and prosperity for all Ghanaians.
GB Food said it will continue to provide an enabling environment to succeed.
Well, next on the marketplace, let's talk tech. I'm joined on Zoom by Henry Kobler, who is lead for Eyes of Africa, a tech pundit here on the marketplace. We want to begin with this story that has caught our attention. The Ghana Revenue Authority beginning the first phase of the EVAT implementation at the end of this month. Tell us a bit more, Henry, about what you know about this and how significant this is.
Thank you very much, Daryl. So this is very significant. I mean, if you're looking at our tax regime, tax has been one of the most talked about in terms of our nation's development. And so how we basically being able to get our taxes and then being able to declare taxes is very important. Over the time, we've seen how GRA basically has been looking into different areas in terms of making sure that we're able to have some level of tax generations. And so I think that basically this is a technology that's been introduced to make sure that businesses are able to rather use those tech to be pushing up what you call it, cost to clients, and also be able to get some level of revenue from their sales and services that they're providing to clients. So it's generally having the technology surface in this time around, so that we sort of move away a bit from the regular manual processes where businesses have to now go through their own process of declaring how much they've actually made in terms of business and their proceeds, and then also go ahead to declare their taxes and then also pay their taxes. I think that this comes in the point where you actually getting to have the collection of these taxes on an instant front, and also making sure that the manual process is also sort of done with, and also getting to have some level of forecast and analytics coming in terms of the businesses and what they are providing, their services they are providing, and also the taxes that they are going to generate for the government. Yeah,
because my concern really is what can be done to ensure that this technology is efficient, because there have been so many instances we try to introduce something using technology, and then in the middle of the way we are not able to get a hold of it, and then it becomes a fiasco.
I think that what could be done generally, I think that there should be some level of consensus. I'm sure generally basically would have done a lot of work in understanding the businesses that are out there. Businesses tend to be very volatile now in terms of the operations and how they get handled. So generally, I'm thinking that generally basically would have done a lot of research into how to have this deployed into a lot of the businesses. Like there are quite a number of new businesses that are coming in. There are quite a number of people that are starting businesses, sole proprietor businesses that have not been able to pay taxes whatsoever. I can give you an example. There are people that are now Twitter influencers, social media influencers, and they are making tons of money, yet there's no taxes from the withholding taxes. Nobody really even cares about it, because I mean, at the end of the day, if they are getting withholding taxed and they are getting their certificate, they don't even sort of declare it for them to also have some level of due diligence and balancing from the other side of business. So I think that it's more of understanding the businesses that are out there and being able to integrate this technology into what they already do. There are quite a number of systems that are already out there deployed for most businesses. How is this going to be integrated? A number of times I've seen generate stuff in the malls and in bigger supermarkets, only just checking receipts and putting some diligence. I mean, sometimes I just laugh at that whole process, but I think that they sort of have some level of intelligence to it. But I just don't see how you're going to have almost about 500 customers walk past you and you're writing the amount of their receipts on a paper and going to do manual calculations. I don't think that it basically works out better. And so I think that the integration, or how this system is sort of going to sync and speak to a lot of the deployed systems already used by companies and businesses and even individuals, is going to be a key point in having the achievement of this platform work and be able to achieve what they exactly set out to do.
Yeah, integration, very important there. Well, since artificial intelligence is what everybody seems to talk about in the tech world these days, I think we should do something around that. And so Google has announced new AI features in Gmail, Docs, and other apps. What's that?
So I think we spoke about last week the AI wars that are out there. Interestingly enough, AI seems to be the talked about most used tech recently. I have tried and tested ChatGPT quite in extensive points, and I think that is actually looking very dangerous in terms of some of the jobs that are out there and how they're going to be in the future. And so in the tech world, you'd see that Google is also making a lot of headway in how it's going to maximize AI in most of its products that are out there. Now, Google basically has a lot of product which is actually in use. And so it's not just deploying some level of application just once in a while, but they're also looking at how they're going to integrate AI or have AI effectively being used in most of these applications. And so they've sort of launched AI within some of the tools that they've already deployed. So if you're going to write a mail, you're going to have an AI help you craft your mail in a very intelligent way, so it looks more professional to the receiver of your mail. I mean, some of those things are the things that it's doing. It's looking at how chat systems, which is the Google Meet chat system, basically incorporate AI to relatively give a very good feeling in terms of when you're having meetings, taking note of these meetings, being able to have your notes after you've done a meeting, and so you don't necessarily have to be picking up notes when you're writing meeting. And so some of the things that are being incorporated into their main applications, which is out there, is what they are taking advantage of now. Whilst you would realize that their competitors are also now trying to build their AIs into their applications. If you're looking at Microsoft, I mean, Microsoft does not have a lot of products out there. And so Microsoft definitely is now putting in AI, which is the ChatGPT point, into its Bing browsers and all of that. So it's just a competition that's coming out there, and it's just a use of AI in most sensitive applications. It can be dangerous in one part where you're having an AI read most of your mails, your personal stuff, but it also comes a long way to help people that are going to be able to use that.
Henry, we've got to go. It's time. Thank you so much. This AI thing sounds so cool. More news on our website, myjoyonline.com/business. My name is Daryl. Thanks for watching. We are back same time tomorrow.